just your reaction first up to what we got and whether you think we can move on from this now.
Well, I mean, the reaction is that there were good news for the banking sector, for the Eurozone banks. When it comes to the capital stress test, the fact that at the end only is necessary 10 billion euros, that was positive. But at the same time, the asset quality review revealed that up to 50 billion of assets in the banking sector had to be readjusted, which actually that's probably the bad news. This is the bad side of the story, and that means that banks will have to overhaul their risk management practices and the valuation of assets.
And is it that the market is getting a little bit jittery about, or is the market not jittery enough in your view?
I mean, probably is well, the market is reacting according to their expectations, and I think that probably is an accurate reaction. I mean, but at the same time, I mean, the results are going to have a long-term impact probably over the coming months. I mean, the importance of the results is what the banks will have to do when they have to submit their plans to raise capital, which is within 2 weeks. But also, I mean, what they have to do to reassess the valuation of their asset portfolio, which is something that the European Central Bank has pointed out that it will be necessary according to the results of the comprehensive assessment.
You know, one of the things I want to talk about is how the subsidiaries of a lot of these banks, especially the Greek banks and the Austrian banks, how this has hit other regions of Europe, like the Balkans, for example. How bad could this get?
It could get really bad. I mean, most of the asset distress for these banking groups, I mean, we're talking about Italian banking groups, Austrian, Greeks, and even the Portuguese bank, BCP, comes precisely from their exposure to Central and East European banking sectors. That means that in order to remedy that exposure and the risk involved, they have to probably scale down their assets in there. That it will involve the selling of subsidiaries, which is something that the stress test has already anticipated when it spared two Greek banks from having to raise capital, because these banks have already hinted with the restructuring plans that they will probably scale down their activities in the Balkans. So altogether, that will mean significant deleveraging, significant mergers and acquisitions, or probably, I mean, selling of assets in that region, and eventually not helping at all for credit growth, especially in the Balkans. So probably, I mean, tightening credit a bit more.